They just crashed silver on purpose. And I'm going to show you exactly why they did it, who benefits, and what happens next. Because what you're watching right now isn't a normal correction. This is coordinated. This is strategic. And if you don't understand the mechanics behind what just happened, you're going to miss the single biggest setup in the silver market we've seen in years. Today is Sunday, February 1st, 2026. Silver is trading at $83.79. But let me show you what just happened. On Thursday, January 29th, silver opened at $114.58 and rallied to $121.57 before closing at $113.83. Then came Friday, January 30th. Silver opened at $113.91, spiked to $118.59, then absolutely collapsed. The low of the day hit $76.67 before closing at $86.33. That's a $42 drop from Thursday's intraday high to Friday's intraday low. A 35% crash in 2 trading sessions. And here's what they're not telling you. Silver didn't just fall, it was taken down. And the people who orchestrated this move aren't trying to exit the market. They're trying to get in before the real breakout begins. Let me show you the evidence. On January 30th, 2026, the Comex reported a massive one-day withdrawal of physical silver from registered vaults. Over 3 million ounces pulled in a single day. That's not profit-taking. That's panic buying disguised as vault transfers. Because when price drops and physical disappears at the same time, that tells you one thing. The paper market and the physical market are no longer aligned. Someone is using paper contracts to suppress price while simultaneously accumulating metal. And that divergence is about to create the most violent short squeeze we've ever seen. Here's why this matters. Right now, the Comex silver inventory has been declining for 9 consecutive months. We're sitting at the lowest registered silver levels since 2016. That's 10 years of drawdown. And during that same period, industrial demand for silver has exploded. Photovoltaics, solar panel production alone consumed over 161 million ounces of silver in 2025. That number is projected to hit 210 million ounces this year. And it's not slowing down. Every single solar panel requires approximately 20 grams of silver. There is no substitute. There's no alternative material that matches silver's conductivity and efficiency at scale. So when you see price dropping while physical inventory vanishes, you're not watching a bear market. You're watching the setup phase of a supply crisis. Now, let me show you who's behind this move and why they need the price lower right now. The largest accumulators of physical silver over the last 18 months have been sovereign wealth funds and central banks in Asia. Specifically, institutions in China, India, and the Middle East have been converting dollar reserves into hard assets. Silver is the most undervalued hard asset on the planet relative to its industrial utility. It's trading at a gold to silver ratio of 56.1. Historically, that ratio sits closer to 65.1 during normal market conditions. But when financial stress accelerates, that ratio compresses. During the 2011 silver rally, the ratio dropped to 32.1. During the March 2020 crash, it spiked to 125.1 before violently reversing. What we're seeing now is deliberate price suppression ahead of a major accumulation phase. The entities crashing the paper price are not retail traders. They are institutions with multi-billion-dollar balance sheets who need to acquire physical metal at the lowest possible entry point before the breakout occurs. And they are using the Comex futures market to create the exact conditions they need. Here's how the mechanics work. A large institution sells thousands of silver futures contracts during low liquidity hours. Typically, this happens during Asian trading hours or right before the New York market opens. The goal is not to profit from the short position. The goal is to trigger stop-loss orders and algorithmic selling from momentum traders. Once the cascade begins, price drops rapidly. Retail investors panic. Margin calls forced liquidation. And while everyone is selling paper contracts, the same institution is buying physical metal in the spot market at artificially suppressed prices. This is not theory, this is documented behavior. In April 2020, JP Morgan was fined over $900 million for spoofing precious metals markets using this exact strategy. They were placing large sell orders to move the price, then canceling those orders before execution while simultaneously buying physical metal. The fine was the largest in CFTC history. But the strategy didn't stop, it just became more sophisticated. Now, here's where this gets critical for you. The amount of silver available for physical delivery on the Comex is dropping faster than at any point in the last decade. Registered silver, which is the only category eligible for delivery against futures contracts, is now sitting at just over 77 million ounces. That sounds like a lot until you realize that open interest in Comex silver futures represents over 890 million ounces of paper claims. That's a leverage ratio of 11 to 1. For every 1 ounce of physical silver in the vault, there are 11 paper contracts claiming ownership. And here's the problem. If even 10% of those contract holders demand physical delivery, the system breaks. The Comex cannot deliver. The price discovery mechanism collapses and spot price decouples entirely from futures price. That's the trap they're setting right now. Let me show you what's happening in the physical market. While paper price is being suppressed, premiums on physical silver coins and bars have been rising steadily since mid-January. American silver eagles are trading at $6 to $8 over spot price, representing a 12 to 15% premium in some markets. Canadian maple leafs are showing similar premiums. Even generic silver rounds, which typically trade closest to spot, are carrying $3 to $4 premiums. This is not normal. When physical premiums rise, while paper price falls, it signals one thing: physical shortage is developing, while paper selling creates artificial price discovery. The disconnect is widening, and when that gap becomes too extreme, the market corrects violently. We saw this in March 2020 when silver dropped to $12 per ounce on the Comex, while physical coins were selling for $25 to $30 if you could even find them. Dealers were completely sold out. Mints couldn't keep up with demand, and the paper price had zero connection to physical reality. That's exactly what's being set up right now, but on a much larger scale, because the fundamentals supporting silver today are exponentially stronger than they were in 2020. Let me walk you through the supply-demand dynamics that make this setup so explosive. Global silver mine production peaked in 2016 at approximately 900 million ounces per year. Since then, production has been declining. We're now producing around 830 million ounces annually. Meanwhile, industrial demand has been accelerating. Solar panel manufacturing alone will consume over 210 million ounces in 2026, up from 161 million in 2025. Electric vehicles require significantly more silver than traditional combustion engine vehicles. Each EV uses between 25 to 50 grams of silver in various electrical components, sensors, and battery management systems. Global EV production is projected to exceed 30 million units in 2026. That's an additional 750 to 1,500 metric tons of silver demand just from the automotive sector. 5G infrastructure build-out requires massive amounts of silver. Every 5G base station uses approximately 3 to 5 times more silver than previous generation cell towers due to increased circuit complexity and antenna arrays. China alone plans to install over 2 million 5G base stations by 2027. India, the United States, and Europe are following similar expansion trajectories. Medical applications for silver are expanding. Silver nanoparticles are being used in wound dressings, antimicrobial coatings for medical devices, and water purification systems. The medical and healthcare sector now consumes over 60 million ounces of silver annually, and this demand is growing at 8% per year. Add it all up, and total industrial demand for silver in 2026 is projected to exceed 650 million ounces. Mine production is 830 million ounces. That leaves approximately 180 million ounces for investment demand, jewelry, silverware, and inventory replacement. But here's the critical detail they don't tell you. A significant portion of mine production is byproduct silver from copper, lead, and zinc mines. When base metal prices fall or mines become uneconomical, silver production drops as a consequence, even if silver prices are rising. This creates a supply inelasticity that most investors don't understand. Silver supply cannot respond quickly to price signals. It takes years to bring new mines online, and most primary silver mines require prices well above $25 per ounce to be economically viable at current energy and labor costs. At $83 per ounce, you would expect a supply response, but that response takes 3 to 5 years to materialize in the form of new production. Meanwhile, demand is accelerating now. The gap is widening, and above-ground inventories are being drawn down to fill that gap. But those inventories are finite, and we're watching them disappear in real time. The Silver Institute reported that total visible silver inventories, including Comex, LBMA, and Shanghai Futures Exchange, have declined by over 420 million ounces since January 2023. That's 3 years of drawdown, and the rate of decline is accelerating. In 2023, inventories fell by 110 million ounces. In 2024, they fell by 155 million ounces. In 2025, they fell by 155 million ounces again. And in just the first month of 2026, we've already seen a drawdown of over 35 million ounces. If this pace continues, we're on track for a 420 million ounce drawdown in 2026 alone. At that rate, visible inventories will be completely exhausted within 18 months. And when that happens, there's no price discovery mechanism that can handle the demand. Price will have to rise to a level that destroys industrial demand or incentivizes recycling at a scale we've never seen before. But here's the problem. Most industrial applications for silver are not price sensitive in the short term. A solar panel manufacturer is not going to stop production because silver hits $150 per ounce. The cost of silver represents less than 3% of the total cost of a solar panel. Even if silver doubles from here, it's still economically viable to use it. Electric vehicle manufacturers face the same calculation. The silver content in an EV costs approximately $15 to $30 at current prices. Even if silver triples, that's still less than 0.2% of the total vehicle cost. Demand will not decrease meaningfully until prices reach levels that force technological substitution, and that substitution takes years to develop and implement. So what you have is inelastic supply meeting inelastic demand with declining inventories. That's the perfect recipe for a price explosion. And the smart money knows this. That's why they're using paper markets to suppress price while accumulating physical metal. Now let me show you the data that proves this accumulation is happening right now. The US Mint reported that Silver Eagle sales in January 2026 reached 6.2 million ounces, the highest January total since 2015. That's a 340% increase compared to January 2025. Retail demand is surging while price is falling. That's classic panic buying masked as bargain hunting. But retail is not the big story here. The big story is what's happening in the wholesale market. London Bullion Market Association vaults, which holds silver for institutional clients, reported a drawdown of 18 million ounces in January alone. That silver isn't being sold, it's being transferred to private storage, allocated accounts, and sovereign vaults in Asia and the Middle East. Shanghai Gold Exchange physical silver deliveries hit a record 47 million ounces in January 2026. That's the highest monthly delivery total in the exchange's history. Chinese institutions are taking delivery at a pace we've never seen before, and they're not buying paper contracts. They're demanding physical metal and removing it from the exchange system entirely. India's silver imports in January reached 850 metric tons, equivalent to approximately 27 million ounces. That's triple the normal monthly import volume. Indian buyers are historically price sensitive, meaning they buy more when prices fall. But this level of import activity during a price crash suggests something beyond retail bargain hunting. Institutional accumulation is happening. The Middle East is showing similar patterns. Dubai reported record silver vault deposits in January, with over 12 million ounces moving into secure storage facilities. Saudi Arabia and the UAE are converting dollar reserves into precious metals at an accelerating rate as they diversify away from pure dollar exposure. Add it all up, and you're looking at over 110 million ounces of physical silver being moved, delivered or withdrawn from exchange systems in January 2026 alone. That's 13% of annual mine production in a single month. And it's happening while paper price is crashing. The divergence couldn't be more obvious. So who's selling? The answer is simple. Leveraged speculators and momentum traders who are forced to liquidate positions when price moves against them. These are not long-term holders. These are not industrial users. These are paper traders using futures contracts for short-term directional bets. And when the market moves against them, they have no choice but to sell. The institutions engineering this move understand exactly how these forced liquidations work. By timing large sell orders during low liquidity periods, they can trigger cascading stop-loss orders that create the appearance of mass selling. But the underlying physical demand never changes. Industrial users still need silver. Solar manufacturers still need silver. EV producers still need silver. And sovereign wealth funds still want silver. The paper selling is temporary. The physical accumulation is permanent. And once the paper market exhausts its downside momentum, the physical reality will reassert itself with extreme force. Let me show you the technical setup that confirms this. Silver's relative strength index on the daily chart dropped to 22 on Friday, January 30th. Any reading below 30 indicates oversold conditions. A reading below 25 indicates extreme oversold conditions that historically precede sharp reversals. The last time silver RSI hit this level was March 2020, right before it rallied from $12 to $30 in 4 months. The Commitment of Traders report, which tracks positioning of commercial hedgers versus speculators, shows that commercial traders, who are typically the smart money, have reduced their short positions to the lowest level since 2019. Meanwhile, large speculators have built up record short positions, betting on further price declines. This is a classic contrarian setup. When commercials are reducing shorts and speculators are adding shorts, it means the smart money is preparing for a rally while the dumb money is positioned for continued weakness. History shows that commercials are right approximately 80% of the time at major turning points, and right now they're positioning for higher prices. Open interest in silver futures has declined by 15% over the past 2 weeks. This indicates that weak hands are exiting positions, but physical demand hasn't declined, it's increased. That divergence tells you the selling is driven by paper market dynamics, not fundamental supply-demand shifts. Volume analysis shows that the largest selling pressure occurred during overnight trading sessions when liquidity is lowest. This is a classic manipulation signature. If genuine selling were happening based on fundamental reasons, It would occur during high liquidity hours when institutional traders are most active. The fact that the heaviest selling occurred during illiquid hours confirms this as engineered price suppression, not organic market movement. Now here's what happens next. As physical inventories continue to decline and industrial demand continues to grow, the gap between paper price and physical reality will become unsustainable. At some point, either a major industrial user or a large financial institution will demand delivery on their futures contracts, and the Comex will not be able to deliver the required metal. When that happens, one of two things occurs. Either the Comex declares force majeure and settles contracts in cash rather than physical delivery, which would destroy confidence in paper-silver markets entirely, or the price discovery mechanism breaks and spot price decouples from futures price, with physical metal trading at massive premiums to paper contracts. Both scenarios result in the same outcome: a violent price spike as buyers scramble to secure physical metal and sellers realize they cannot obtain the metal needed to cover short positions. This is what happened in nickel markets in March 2022, when the London Metal Exchange had to halt trading and cancel trades because a major Chinese producer couldn't deliver against short positions. Nickel prices spiked over 250% in 2 days before the exchange intervened. Silver has even tighter physical inventories relative to open interest than nickel did at that time. The leverage ratio is higher, the industrial demand is more inelastic, and the number of participants positioned for a squeeze is larger. When this breaks, it will make the nickel short squeeze look like a minor event. Let me show you the specific catalysts that could trigger this squeeze in the coming weeks and months. First, the solar industry is entering peak production season. Spring and summer are when solar panel manufacturing ramps up to meet installation demand. If silver prices remain suppressed while solar manufacturers accelerate orders, we could see Comex inventories drop below 50 million ounces by April. At that level, the market will be operating on razor-thin physical reserves with no buffer for unexpected demand spikes. Second, central bank buying of precious metals is accelerating. The World Gold Council reported that central banks purchased over 1,000 metric tons of gold in 2025, the second highest annual total on record. But several central banks, particularly in Asia, are now diversifying into silver as well. China's State Administration of Foreign Exchange has been quietly accumulating silver through proxy purchases on the Shanghai Gold Exchange. If China officially announces silver reserves or increases disclosed holdings, it will signal to other central banks that silver is a strategic reserve asset, triggering additional institutional buying. Third, currency debasement concerns are intensifying. The US dollar money supply has expanded by over 40% since 2020. The Federal Reserve's balance sheet remains elevated despite attempts to reduce it. Inflation concerns are resurging as fiscal deficits continue to expand. When investors lose confidence in fiat currency stability, they move into hard assets. Gold is the traditional safe haven, but silver offers significantly more upside potential due to its smaller market size and dual role as both a monetary metal and industrial commodity. Fourth, mining supply disruptions are increasing. Political instability in Peru, which produces approximately 13% of global silver supply, has led to periodic mine closures and production disruptions. Mexico, the world's largest silver producer, is facing new mining tax proposals that could reduce profitability and slow production expansion. Water shortages in Chile are impacting copper-silver mines. Energy costs in Europe are making some silver recycling operations uneconomical. Each of these factors reduces available supply while demand continues to grow. Fifth, technological demand is accelerating faster than forecasted. Artificial intelligence data centers require massive amounts of silver in servers, cooling systems, and power distribution infrastructure. A single large-scale AI data center can consume over 50,000 ounces of silver in electrical components and connections. Major tech companies are building dozens of these facilities globally. This demand was not factored into silver's supply-demand models even 2 years ago, and it's growing exponentially. Sixth, investment demand is poised to return. ETF holdings of silver declined from 2022 through early 2025 as investors rotated out of precious metals and into equities and crypto, but that trend is reversing. Silver ETF holdings increased by 8 million ounces in January 2026, the first monthly increase in over a year. If investment demand returns to levels seen in 2020-2021, when ETFs added over 300 million ounces, it would create a demand surge that mine production simply cannot meet. Now let me give you the price targets based on these fundamentals. If silver simply returns to the gold to silver ratio of 65:1, which is the historical average, and gold holds current levels around $2,800 per ounce, silver would trade at $43. But that's a conservative baseline that assumes no supply crisis and no major shift in investment demand. If the ratio compresses to 50.1, which is reasonable during periods of financial stress, silver reaches $56 per ounce. If it compresses to 40.1, Similar to what we saw during the 2011 rally, silver hits $70. And if we see a genuine supply crisis where physical delivery becomes constrained, the ratio could compress to 30.1 or lower, putting silver at $93 to $100 per ounce. But those targets assume gold remains stable. If gold rallies to $3,200 or $3,500 as some analysts are forecasting due to central bank buying and inflation concerns, then silver targets move significantly higher. At $3,200 gold and a 50.1 ratio, silver trades at $64. At $3,500 gold and a 40.1 ratio, silver reaches $87.50. At $3,500 gold and a 30.1 ratio, during a short squeeze scenario, silver hits $116. And if we see a genuine Comex default or force majeure event where physical delivery fails, all traditional price models break down. In that scenario, physical silver could trade at any price necessary to clear the market, potentially reaching $150, $200 or higher, until either industrial demand is destroyed or massive recycling supply comes online. The key point is this: the downside is limited and the upside is enormous. Silver is currently trading 30% below its January highs. It's sitting at critical technical support levels. Physical inventories are at decade lows. Industrial demand is at all-time highs. The leverage ratio on the Comex is extreme. And institutional accumulation is accelerating while paper price is being suppressed. This is not the time to panic. This is the time to pay attention. Because what you're witnessing right now is the setup phase of the largest silver rally in modern history. The entities engineering this price suppression are not doing it to profit from short positions. They're doing it to acquire physical metal at the lowest possible prices before the inevitable supply crisis forces prices exponentially higher. The evidence is everywhere. Record physical withdrawals from Comex vaults, surging premiums on physical coins and bars, record deliveries on the Shanghai Gold Exchange, record imports into India, record U.S. mint sales, declining registered inventories, rising industrial demand, contracting mine supply, and institutional positioning that suggests the smart money is preparing for a major rally. If you understand what's happening, this crash is not a disaster. It's an opportunity, because the entities suppressing price today will be the same entities bidding it up tomorrow once they've finished accumulating. And when that shift happens, the move will be violent, fast, and impossible to chase. The silver market is the most manipulated market in the world, but it's also the most explosive when manipulation breaks. And we are closer to that breaking point than we've ever been. The physical shortage is real, the demand is real, the inventory drawdowns are real, and the coming price spike is inevitable. So watch what happens in February and March 2026. Watch the Comex inventory reports. Watch physical premiums. Watch delivery data from Shanghai. Watch ETF flows. And watch for the moment when paper sellers exhaust themselves and physical reality takes over. Because when that moment comes, silver won't just rally, it will explode. And everyone who understood what was really happening during this engineered crash will be positioned perfectly for the most profitable trade of the decade. This is not financial advice. This is information. What you do with it is your decision. But if you miss this setup, you will regret it. The evidence is all there. The pattern is clear. And the opportunity is massive. The silver crash of January 2026 wasn't a collapse. It was a setup. And now you know exactly what's coming next.